Welcome to the deep dive. Wow, you've sent us a ton of accounting stuff this time. Textbook excerpts, financial statements, even some stuff on forensic accounting. Looks like we've got our work cut out for us.
It is a pretty diverse collection, that's for sure.
Uh-huh.
But yeah, no, I'm excited to dig in. I think we can definitely unpack some fascinating insights from all this for our listeners.
Okay, so the first thing that jumped out at me, flipping through these textbook excerpts, is this idea that accounting is more than just number crunching. It's almost like a language, right?
Yeah, absolutely. It's like taking raw data, financial data, and turning it into a narrative that people can actually understand and use.
And just like any language, it has its own kind of special vocabulary, right? Like
Mhm.
debits, credits, the accounting equation, all that.
Exactly, exactly. And just like grammar rules, accounting has its own principles and standards.
Mm-hmm.
But the real skill, the real art of it, is in the interpretation.
Wow.
Taking those numbers and using them to paint a picture of a company's financial health, performance, even its potential for the future.
So it's not just about balancing the books. It's about using those numbers to actually make decisions, to understand what's really going on.
Precisely, yeah. And what I find fascinating is that accounting really touches everyone, not just finance people.
Oh, absolutely.
Think about it. When you're making your personal budget, you're basically using accounting principles to track your income and expenses. Same thing when you're deciding to invest in a stock, you're relying on accounting information to figure out if that company's a good bet.
That's a good point. I never really thought about it that way. It really is kind of working behind the scenes in so many aspects of our lives, isn't it?
It really is, yeah. And the scope of accounting, I think people would be surprised. It's much broader than many realize. I mean, this pile of materials you sent, it covers everything from basic bookkeeping to stuff as complex as forensic accounting, where accountants are basically like financial detectives trying to uncover fraud and other crimes.
Oh, yeah. Okay, so let's unpack some of these concepts a little bit. I mean, the textbook here goes pretty deep into some fundamental accounting principles, and I think it'd be helpful to start with this thing called the going concern concept. Can you explain what that is and why it matters?
Sure, sure. So the going concern concept, it basically assumes that a business is going to continue operating for the foreseeable future. And that assumption, it's pretty fundamental because it impacts how we actually value a company's assets.
So, like, if we think a company's going to stay in business, we look at its assets differently than if we thought it was about to go under.
Right. For example, if we assume a company's going to keep operating, we value its assets based on how much income they're expected to generate in the future. But if we think a company's on the verge of bankruptcy, well, then the value of those assets could drop significantly because now we're thinking they'll probably have to be sold off quickly, maybe even at a loss.
I see. So it's not just about what an asset is worth right now. It's about what it's projected to be worth down the line, assuming, of course, that the business is still around.
Precisely. Now, another key principle we should touch on is the money measurement concept. This one sounds pretty straightforward, but it actually highlights some of the limitations of traditional accounting.
Okay, how so?
Well, basically, the money measurement concept says we can only really record things in accounting if they can be measured in monetary terms, right? So we can easily quantify things like sales revenue, cost of goods sold, the value of equipment. But how do you put a dollar value on something like employee morale or brand reputation
Right.
or a company's environmental impact?
Right. Those things are definitely important, but they're not usually reflected in the traditional financial statements.
Exactly. And I think this leads to some pretty interesting questions about what we really consider value in a business, right? Like, are traditional methods really capturing everything that contributes to a company's long-term success? The big question.
Yeah, definitely. Now, there's another concept here that I'll be honest, found a little counterintuitive. The cost concept. It basically says that assets are recorded at their original purchase price, not their current market value. Why is that?
Yeah, I get it. That one can seem a little strange at first. But the main reason is reliability and verifiability, you see. Think about it. The market value of an asset, that can fluctuate wildly depending on all sorts of factors. It can be hard to pin down a truly objective and consistent value.
Yeah, okay.
But the historical cost, the price the company actually paid for the asset, that's a solid number. It's auditable. It's not subject to those market swings, you see.
So even if an asset has, like, skyrocketed in value since it was bought, it's still listed on the balance sheet at its original cost.
That's right. And this can definitely create a difference, sometimes a pretty big one, between what's called the book value of an asset, that's the value on the balance sheet, and its actual fair market value.
Yeah.
Like, let's say a company bought a piece of land 20 years ago for, I don't know, $100,000. And that land is now worth, let's say, $1 million.
Whoa.
It's still going to be recorded on the balance sheet at that original $100,000, even though its market value is way higher.
Wow. That seems like it could create some problems, no?
It can certainly lead to some interesting situations, especially when you have companies trying to raise capital or maybe get acquired. Because investors and potential buyers, they're going to look beyond that book value, right? They want to know what the asset is really worth in the market to get a true picture of the company's value.
That makes sense. Now, the textbook mentions that these seemingly simple concepts, going concern, money measurement, and cost, they can actually clash sometimes, making things a bit more complex than they appear at first glance. Can you give us an example of how these principles might conflict in a real-world scenario?
Absolutely, yeah.
Yeah.
Let's imagine a company that has, I don't know, a big manufacturing facility, right? The going concern concept says, okay, this facility is going to keep operating, generating revenue for the foreseeable future. But what if that company is starting to face some tough competition? Maybe sales are declining, there are rumors they might have to shut the facility down. What happens then?
Well, I guess that would really challenge that going concern assumption, wouldn't it?
Exactly. And if they did have to shut down that facility, the value of that asset would likely plummet. Suddenly, the cost concept, which tells us to stick with that original purchase price, might not be so relevant or accurate anymore.
So it's a balancing act, isn't it? Accountants have to weigh all these different principles and use their best judgment to figure out the most appropriate way to represent the company's financial situation.
That's exactly it. And that's why accounting is more than just a set of rules. It requires critical thinking, analysis, a real understanding of the broader business context. It's a dynamic profession, that's for sure.
Now let's move on to the heart of financial reporting, the financial statements themselves. We've got some examples of income statements and balance sheets here. And I'll admit, looking at them, it can be a bit overwhelming at first glance.
I can understand that. But honestly, they're not as scary as they might seem. Think of the income statement like a movie, showing how a company performed over a certain period, let's say a year or a quarter. It basically tells you how much revenue they brought in, how much they spent on expenses, and ultimately whether they made a profit or took a loss.
So it's like a report card showing how well they did over time.
Yeah, that's a good way to put it. Now, the balance sheet, on the other hand, that's more like a snapshot taken at a specific moment in time. It shows what the company owns, their assets, and what they owe to others, their liabilities. And the difference between those two, that represents the company's equity, the owner's stake in the business.
So if the income statement is like a movie, the balance sheet is like a photograph capturing one specific point in time. And together, they give you a pretty comprehensive view of a company's financial health.
Exactly. And by really digging into these statements, we can start to answer some key questions like, is the company profitable? Are they growing? Are they taking on too much debt? Are they managing their cash flow effectively?
All really important questions. You also sent us some financial reports for a company called, I think it's XYZ, which could be a helpful real-world example to see how these statements actually work in practice.
Yeah, that's a great idea. Let's dive into those reports and see what we can uncover. It'll bring everything to life.
Sounds good. And for our listeners who might be feeling a little lost, hang in there. We're going to break it all down step by step so you can follow along.
Absolutely. We'll start with Company XYZ's income statement, which will give us a good sense of their revenue, expenses, and profitability over the past year.
Okay, so looking at Company XYZ's income statement, the first thing that pops out is their revenue. Over $500 million last year. That's pretty impressive, isn't it?
It is. It is. A substantial figure for sure. But revenue alone, that doesn't tell the whole story. We really need to factor in their expenses to see how much profit they actually generated.
Right, because profit is what's left over after all those costs, the cost of doing business.
Exactly. And looking at their income statement, we can see their cost of goods sold was around $250 million. That's basically the direct cost of producing whatever it is they sell, whether it's goods or services.
So like half their revenue went straight back into making their products.
Yeah, think of it that way. And then they had operating expenses, another $150 million or so. Things like salaries, rent, marketing, administrative costs, all that falls under that category.
So that leaves them with, what, about $100 million in operating income? Not bad.
It's a healthy number, yeah. But we're not quite done yet. We still need to consider things like interest expense and taxes.
Right. Right, especially if a company has a lot of debt, that interest can really eat into their profits.
Absolutely.
Yeah.
In XYZ's case, their interest expense was relatively small, only about $5 million. So after we account for taxes, their net income, their bottom line profit, came in at around $60 million.
Okay, so even with all those expenses, they're still making a decent profit. But how does this compare to previous years? Are they growing or are they shrinking?
That's the key question, right? To figure that out, we need to compare their income statements over time, see if their revenue, expenses, and profits are trending upwards or downwards.
And that's where things start to get really interesting because those trends can reveal a lot about the underlying health of a company, whether they're on the right track or if there are some warning signs.
Couldn't agree more. Like, if you see revenue growing steadily while expenses are being managed, that's generally a good sign. But if revenue is flatlining, or even worse, declining, and expenses are creeping up, that could be a signal that something's not quite right.
Yeah. And even if a company is profitable, I guess it's important to know where that profit is coming from. Is it sustainable growth? Or are they relying on one-time gains or accounting tricks to boost their number?
Exactly. You got it. It's about looking beyond the surface, understanding the story that those numbers are telling.
Okay, so we've talked about the income statement. Let's switch gears now and look at the balance sheet, that snapshot of a company's financial position at a specific moment. What are some of the key things you look for when you're analyzing a balance sheet?
Well, the balance sheet basically tells us three main things: what a company owns, their assets; what they owe to others, their liabilities; and what's left over for the owners, their equity. I always start by looking at the assets. What are their most valuable assets? Are they mostly tangible things, like property and equipment? Or are they more heavily weighted towards intangible assets, like patents, trademarks, goodwill?
And those intangible assets, those can be a little trickier to value, can't they? And maybe a bit more volatile than physical assets.
Absolutely. And then I look at the liability side. How much debt do they have? What are the terms of that debt? Are they generating enough cash flow to comfortably handle those debt payments?
Because too much debt can definitely put a company at risk, especially if interest rates start to rise or if their business takes a hit.
Precisely. And finally, I look at their equity. How much of the company is owned by the founders versus outside investors? Have they been issuing a lot of new shares, which can dilute the ownership of existing shareholders?
So by really digging into that balance sheet, you can get a good sense of a company's financial strength, their risk profile, their overall capital structure, right?
That's the idea. And remember, the balance sheet and income statement, they're interconnected. A company's profitability, which we see on the income statement, that's ultimately going to affect their equity on the balance sheet.
Makes sense. Now, in company XYZ's financials, there's this section called management discussion and analysis that I found really interesting. It's like management's own commentary on the numbers, providing some context, explaining their thinking.
Oh, yeah, I love that section. It's really valuable. It's where management gets to highlight the key trends, the factors that are driving performance, But also, they talk about the risks and challenges they're facing and how they plan to deal with them.
For example, in XYZ's report, they mentioned that increased competition is a big concern. And they're also dealing with rising raw material costs, which is putting a squeeze on their profit margins.
Right, and that reflects a broader trend that a lot of companies are struggling with right now. Supply chain issues, inflation. It's all making it more expensive to do business.
And it looks like XYZ is trying to adapt by investing in new technology, trying to improve efficiency, stay ahead of the curve. But that's also leading to more debt, which we can see on their balance sheet.
It's a classic dilemma, isn't it? Sometimes you have to take those calculated risks, invest for the future, even if it means taking on more debt. The key is finding that balance, balancing growth with financial prudence.
Speaking of finding balance, that brings us to another important topic from the materials you sent: accounting standards, specifically GAAP, or generally accepted accounting principles.
Ah, yes, GAAP, the bedrock of financial reporting. These standards are so important because they ensure that financial statements are prepared in a way that's consistent and comparable across different companies. Imagine trying to compare two companies that use completely different accounting methods. It'd be like comparing apples to oranges.
So GAAP, it's like a common set of rules that everyone has to follow, which makes it easier for investors, creditors, and other stakeholders to understand what they're looking at, right?
Exactly. GAAP covers a wide range of stuff: how to recognize revenue, how to value inventory, how to account for depreciation, all kinds of things. By sticking to these standards, companies can make sure their financial statements are transparent, reliable, and, importantly, auditable.
But are there ever times when GAAP can be too rigid? Maybe it doesn't accurately reflect the unique circumstances of a particular business. Are there exceptions to the rules?
That's a good point. GAAP, it's a complex set of rules, and there's definitely some room for interpretation and judgment involved. Sometimes companies might need to deviate from GAAP if they truly believe it's necessary to present a fair and accurate picture of their financial position.
So it's not just about blindly following the rules, it's about understanding the principles behind those rules and using them to create financial statements that are both compliant and informative.
Exactly. And that's what makes the role of an accountant so important. It's not just number crunching. It's about understanding those nuances of GAAP, making those sound judgments, and communicating those sometimes complex financial issues in a way that people can actually understand.
And speaking of complex financial information, one of the things that really caught my eye was this concept of inflation accounting. Can you explain what that is and why it's becoming increasingly relevant in today's economy with prices going up everywhere?
Oh yeah, inflation accounting, it's super relevant right now given all the rising prices we're seeing. Traditional accounting, it kind of assumes that the value of money stays the same over time, but we all know that's not really how it works, right?
Yeah, inflation definitely eats away at the purchasing power of money. A dollar today doesn't buy you nearly as much as it did a year ago.
Right, so if a company bought a piece of equipment for, let us say, $100,000 10 years ago, its value on the balance sheet might be way understated now because of inflation. That's what inflation accounting is trying to address. It aims to adjust those financial statements to reflect the current purchasing power of money to give a more accurate picture of the company's true financial performance.
But how do you even begin to measure the impact of inflation on, all of a company's assets and liabilities? It seems like a very complex process.
It can be, for sure. There are different approaches to inflation accounting. Some use general price indices to adjust for overall inflation, while others focus on specific price changes for different categories of assets. It often requires specialized expertise and some pretty sophisticated models to do it accurately.
It sounds like a very niche area of accounting, but definitely one that's becoming more and more important as inflation continues to be a big concern.
Absolutely. As we navigate these uncertain economic times, inflation accounting can be a really valuable tool. It helps us understand the true impact of rising prices on businesses and make better decisions about investment, pricing, resource allocation, all sorts of things.
Okay, shifting gears a bit, I'm really curious to dive deeper into that world of forensic accounting that we touched on earlier. It's such a cool concept, like accounting meets detective work, using your skills to uncover financial crimes. What are some of the unique things about forensic accounting that make it so challenging and, well, just plain interesting?
The thing about forensic accounting, it goes way beyond your typical audit. It's not just about checking if the numbers add up. It's about trying to understand the intent behind those numbers. We're looking for patterns, anomalies, anything that seems out of place that might point to fraudulent activity.
Like piecing together clues like a financial detective.
Exactly. And the challenges are many, believe me. We're often dealing with very complex financial transactions, incomplete records, and people who are actively trying to cover their tracks.
Yeah.
It takes a special combination of skills, accounting expertise, investigative instincts, even an understanding of human psychology.
The textbook mentions this thing called the fraud triangle as like a framework for understanding why people commit fraud. Can you break that down for us a bit?
Yeah, the fraud triangle, it's a really useful tool. It helps us understand the motivations and opportunities that can lead to fraud. It boils down to three elements: pressure, opportunity, and rationalization. Pressure refers to any financial or personal pressures that might push someone to commit fraud. Think overwhelming debt, the pressure to hit unrealistic performance targets, things like that.
So like they feel like they have no other choice, like they're backed into a corner.
Right, exactly.
Yeah.
Then you have opportunity, which basically means weaknesses in the company's internal controls, processes or procedures. Things like lack of oversight, poor record keeping, even a company culture that just kind of turns a blind eye to things.
So it's not always about just like bad people. It's also about systems that make it easier for those bad things to happen.
Absolutely. The environment matters a lot. And then you have rationalization. This is how people justify their actions in their own minds. They might convince themselves they're not really hurting anyone, that they deserve the money, that they'll pay it back someday.
It's a dangerous combination, isn't it? Those three things together can lead even well-intentioned people down a really bad path.
It really is. And the consequences can be devastating, not just for the individual, but for the companies, investors, employees, everyone who gets caught in the fallout.
And we've seen some high-profile examples of that, right? Like the Enron scandal, which the textbook mentions. That brought down a huge energy company and really shook investor confidence in the whole market.
Oh yeah, Enron. That's a classic case study. It shows how greed, arrogance, and a lack of ethical oversight can lead to a complete disaster. They used all these complex schemes to hide debt, inflate profits, and ultimately the whole house of cards came crashing down.
It's a good reminder of why accounting, integrity, transparency, those things are so crucial for a healthy economy. You need that trust.
Absolutely. And it underscores the importance of forensic accounting. Having those financial detectives out there to deter and detect these crimes, hold people accountable, help restore that trust in the financial system.
Okay, so we've talked about different types of accounting: financial accounting, management accounting, tax accounting, forensic accounting. What are some of the core skills and qualities that all accountants need to have to really thrive in this profession?
Well, at its core, accounting is about problem solving, analysis, and communication. So you definitely need to be comfortable working with numbers.
Right.
But you also have to be able to think critically, identify patterns, draw meaningful conclusions from the data you're looking at.
So it's not just about being good at math. You have to be a strategic thinker, too, and a good communicator.
Yeah, exactly. You have to be able to explain complex financial concepts to people who aren't financial experts. Whether you're presenting to management, talking to investors, advising clients on tax strategies, you have to be able to make it clear and understandable.
And in today's world, things are changing so fast. Accountants need to be adaptable too, right?
Yeah.
Lifelong learners.
100%. The accounting profession, it's constantly evolving. New technologies, new regulations, new business models popping up all the time. You have to embrace change, stay ahead of the curve, keep learning throughout your career.
I think we've done a good job of showing in this deep dive that accounting is anything but boring. It's actually pretty exciting. There's intrigue, complexity, even a little bit of drama sometimes.
I couldn't agree more. It's a field that touches every aspect of business, every aspect of society. It's about understanding those financial forces that shape our world, making those informed decisions, ensuring that businesses operate ethically and transparently.
Yeah, well said. Now, you mentioned earlier that accounting can sometimes be seen as a bit dry or boring, but I think we've shown in this deep dive that it's anything but. There's intrigue, complexity, and even a bit of drama in the world of accounting.
I wholeheartedly agree. Accounting is a fascinating field that touches every aspect of business and society. It's about more than just numbers. It's about understanding the financial forces that shape our world, making informed decisions, and ensuring that businesses operate with integrity and transparency.
So for those of you listening who might be considering a career in accounting, I hope this deep dive has given you a better understanding of the challenges and rewards this profession offers.
And for those of you who simply want to be more informed citizens and savvy investors, remember that a basic understanding of accounting can empower you to make better financial decisions in your own lives.
Now, we've covered a lot of ground in this deep dive, from fundamental accounting principles to the complexities of financial statements to the intriguing world of forensic accounting. But one emerging trend that we haven't explored in detail yet is human resource accounting. Can you give us a brief overview of this concept and why it's gaining traction in the business world?
You're right. Human resource accounting is an exciting area that's challenging traditional accounting methods. It recognizes that a company's employees are one of its most valuable assets, and it attempts to quantify the value of human capital in a way that's comparable to financial capital.
So instead of just focusing on tangible assets like buildings and equipment, human resource accounting tries to measure the value of things like employee skills, knowledge, experience, and even loyalty.
Exactly. And the challenge lies in developing reliable methods for measuring these intangible qualities. Some approaches focus on the cost of recruiting, training, and retaining employees, while others try to quantify the future economic benefits that employees are expected to generate for the company.
It seems like a complex and evolving area, but one that's gaining importance as companies increasingly recognize the strategic value of their human capital.
Absolutely. In today's knowledge-based economy, a company's success is often determined by the quality of its workforce. Human resource accounting provides a framework for understanding and measuring the value of that workforce, enabling companies to make more informed decisions about talent acquisition, development, and retention.
It's a fascinating example of how accounting is adapting to the changing needs of the business world, moving beyond purely financial metrics to encompass a broader view of value creation.
Indeed. And as we continue to grapple with issues like talent shortages, skills gaps, and the changing nature of work, human resource accounting is likely to play an even more prominent role in shaping business strategy and decision-making.
Now, before we wrap up this deep dive, I want to circle back to one of the key themes that we've touched on throughout our conversation: the importance of ethical behavior in accounting. We've seen how fraudulent activities can have devastating consequences, and we've discussed the role of forensic accounting in uncovering these crimes. But what are some of the steps that companies can take to promote an ethical culture and prevent fraud from happening in the first place?
That's a crucial question. Creating an ethical culture starts at the top, with leaders setting the tone and demonstrating a commitment to integrity and transparency. It's about fostering an environment where employees feel comfortable speaking up if they see something wrong, and where there are clear consequences for unethical behavior.
So it's not just about having rules and regulations. It's about creating a culture where people do the right thing, even when no one is watching.
Exactly. Companies can also implement robust internal controls to prevent and detect fraud. This could include things like segregating duties, requiring multiple approvals for transactions, conducting regular audits, and using data analytics to identify unusual patterns or anomalies.
And technology is playing an increasingly important role in fraud prevention and detection. We're seeing the use of artificial intelligence and machine learning to analyze vast amounts of data and flag suspicious activity in real time.
It's an exciting area of development. By combining human expertise with cutting-edge technology, companies can significantly enhance their ability to present and detect fraud, safeguarding their assets and protecting their reputation.
Now, one final question before we wrap up. We've talked a lot about the importance of understanding financial statements and accounting concepts, but what advice would you give to our listeners who are just starting their journey into the world of finance and accounting? Where should they begin?
That's a great question. The world of finance and accounting can seem vast and intimidating at first, but the key is to start with the fundamentals. Develop a solid understanding of basic accounting principles, learn how to read and interpret financial statements, and stay curious about how businesses operate and create value.
And don't be afraid to ask questions. There are plenty of resources available, from textbooks and online courses to mentors and professional organizations that can help you build your knowledge and skills.
Absolutely. And remember that accounting is more than just a set of rules and procedures. It's a dynamic field that's constantly evolving, offering endless opportunities for growth, learning, and making a real impact on the world.
Yeah, I think it has been. We really covered a lot. You know, one thing that really strikes me is how accounting, it's this blend of like art and science.
Oh, that's interesting. How so?
Well, you have these fundamental principles, these standards, but there's also a lot of room for judgment, for interpretation. It's not just plugging numbers into a formula. It's about understanding the context, the nuances, the story behind the numbers.
Yeah, I like that. It's like you're a detective, but you're also a storyteller.
Exactly. You gather the evidence, you analyze the data, but then you have to present those findings in a way that people can understand, that helps them make decisions.
And make those informed decisions.
Right, right. And I think that's what keeps accounting so interesting. It's always evolving, always adapting to new challenges, new technologies. We've seen that with inflation accounting, human resource accounting, even the rise of forensic accounting. It's a field that's always pushing the boundaries, finding new ways to measure and create value.
And as we talked about earlier, accounting is more than just a profession. It's a language that everyone can benefit from understanding, Whether you're managing your own personal finances, investing in the market, or running a business, having a good grasp of those accounting principles can really empower you.
For sure. So for our listeners who are feeling inspired now, want to learn more, what advice would you give them? Where should they go to deepen their understanding of accounting?
Well, there are tons of great resources out there. You've got the traditional route, like textbooks, university courses, but there are also so many online courses, tutorials, even podcasts these days that can give you a really solid foundation.
Yeah, there's definitely no shortage of ways to learn.
And don't underestimate the power of real-world experience,
Yeah.
Look for opportunities to volunteer or maybe intern at a local business or a nonprofit. Get some hands-on experience with bookkeeping, financial reporting, even just helping to manage budgets. You'd be surprised how much you can learn by actually doing the work.
Learning by doing, it's definitely the best way.
Absolutely. And remember, This is a global profession. There are opportunities in so many different industries all over the world. It's a field that can open doors to a really rewarding career.
I think we've covered pretty much everything we set out to explore in this deep dive into accounting. From the basics to the more complex stuff, we've untangled those financial statements, talked about ethical considerations, even peeked into the world of those financial detectives, the forensic accountants.
Hopefully our listeners are walking away with a new appreciation for how important accounting is. It's a field full of surprises, intellectual challenges. It plays a vital role in shaping the world around us.
Well said. So whether you're a seasoned finance pro or just starting to dip your toes into the world of accounting, remember there's always more to learn, always more to discover, and you can always use those accounting skills to make a difference.
And don't forget the most important lesson. Behind every number, there's a story. Take the time to understand that story, and you'll really unlock the power of accounting.
That's a great takeaway. Thanks for joining me on this deep dive. It's been a pleasure exploring the world of accounting with you. And to our listeners, thanks for tuning in. We hope you enjoyed the journey. Until next time, keep exploring, keep learning, and keep asking those questions. The world of accounting is waiting to be discovered.